This is the Times Television Network, and you're watching ET Now.
Hi there, and thank you for tuning in. You're watching Swatantra, an investor education series between UTI and ET Now. The idea with this series over the next 1 year is to hold your hand through the entire investment process. We'll take you through how to begin investing, how to make a smart portfolio, how to choose all of the various components that go into that portfolio, and finally, how to use that portfolio to get rich over the long term. That's our final goal. To help us through the next step of investing, I have two wonderful guests in the studio. I'm going to very quickly introduce them. Gaurav Suri is the Senior Vice President, Executive Vice President and Head Marketing at UTI AMC. Thank you for joining us. And Vineet Arora, Executive Vice President and Head Product and Distribution at ICICI Securities. Gentlemen, thank you so much for coming in. Our audience has a lot of questions for you. But I'm going to pick up where we stopped in the previous episode, where we were talking about long-term portfolios. We're talking about various asset classes. And one of the things that came up, and I know a lot of investors have this question, is that you assume that mutual funds are directly linked to the stock market. So all mutual funds have stock market risks, which is not true. I can also use a mutual fund instead of a fixed deposit to give me similar, if not slightly better returns. I can use a mutual fund instead of investing in gold, and very soon I'll be able to use a mutual fund instead of buying real estate. So I want to start by talking about the various types of mutual funds as opposed to just using it for equity.
So if you look at mutual funds, let's segment them into 3-4 asset classes. So one is real estate, one is gold, one is debt, and then there is equity. So equity, I think most of us understand, because that's what we see mutual fund usually as, equity. And we know that once you buy a mutual fund, it will go and invest into various kinds of equity instruments based on the sectors, based on the mandate. Debt is a little more interesting product because debt is not so well known. But mutual fund as a product can give us insight into debt as well. So it can be short-term, accrual. FMPs are actually equivalent of FDs, where you invest into a mutual fund and you get a return at the end of 3 years, and it's based on a maturity plan. There are short-term which work very close to a fixed accrual kind of a fund, so you keep on accruing. However, the returns could vary a little bit with market, but it doesn't vary as much, so it's less volatile. You go into gold, there are ETFs, there are exchange-traded funds, there are mutual funds which feed into an exchange-traded fund, and REITs, once they come in, I think that's an interesting topic to talk about.
Well, Gaurav, take us through this. I mean, we talked about the different types of mutual funds. Now, it doesn't make sense for me to go out and buy one of each. I have to figure out what my goals are for this money, and this is something that all investors should keep in mind. A financial goal, to very quickly take you through it, is not just that I want to be rich when I get older. A financial goal needs to have two things. One is the time horizon, the other one is the actual monetary goal. So it should say that I want 20 lakh rupees in 10 years when my son turns 18. If you don't have either the number or the date, then that's not a financial goal. So assume I do have a financial goal and I've set that out. Then how do I go about matching an investment to the goal?
My analogy for that is like building a home, right? So what we're trying to do is a financial home. The various rooms in a house are basically your goals and aspirations, and you need an expert to really help style and plan the room, and then decide on the furniture, which are products which you actually end up buying. But in our lives, we end up buying a whole lot of furniture without even deciding the chassis or the home. So I think so it's important, first of all, to figure out what are your needs, and they could be wealth creation needs, it could be goals like you're saying, future financial needs around education, marriage, going abroad, seeing the world, retirement, meeting other obligations. It could be as simple as tax saving. I think so once those are fixed, then you go about looking at the horizon you have for the needs, and then building a product portfolio around that. And it could be a mix of what Vineet just alluded to, mix of debt products as well as equity products, basis the tenure and the horizon you have to meet that financial need.
If you're horizon, or if your goal is any less than 3 or 4 years away, you should be completely in debt. When you're
Right.
3, 4, 5 years and above, then you start looking at equity. If you're above 10 years, then you can start looking at aggressive equity. So there's a balanced fund that will breach the gap in between those two things. And of course, gold if you want to beat inflation, although this particular year, that's completely, that entire, theory is completely being debated. The gentleman in the back has a question.
At times we have multiple goals. Can ULIP be looked into as an investment?
Absolutely.
Vinith, you want to take this? I mean, this is, there are two questions here again. I'm going to do this again. I'm going to break it up. One is, of course, can the ULIP, because it has insurance and it has investments combined together, can it be taken as an insurance plan, as an investment plan? The question is how efficient an investment plan is it?
Right.
The second one is, because each of us have, like you said, different rooms, we have different goals. Some of them are 5 years away, some of them are 10 years away. Can I have that one portfolio, one investment to suit all my goals? Is that at all possible?
Okay, so I'll also take it in two parts.
Yeah.
The first part is that can ULIP be an investment tool? So I'll just go a step back and say that, what do we need when we talk about financial planning or we talk about goal-based planning? One is we need an instrument which will do wealth creation. So an instrument where I can invest regularly and it will help me invest towards my goal, and the monetary value of that entire assets will become close to the amount that I want to achieve at the end of the goal. Then there is a protection element to it, because all these are going to be in future. When these are going to be in future, there could be risks which will come on the way, and these risks can be health risk or it could be life risks. That's where a protection element is required, because you want the goal to be achieved in any case. So then you need a protection element. Now what does ULIP do as a product? ULIP combines these two as a product. And it does an investment, it also gives you a protection. So it is important, if you're buying a ULIP, to buy the right protection and then look at the investment, because protection should be looked at first when you're buying a ULIP.
So it can be termed as a mutual fund?
ULIP is actually a mutual fund along with the protection.
Yeah.
Okay, so if you want to term it like that, you can term it like mutual fund along with the
value-added mutual fund, I would say.
But it has a different kind of a structure. So you have to understand that, is this suitable for a investment which I want to maybe redeem after 4 or 5 years? Then the chart structure will look much more lopsided against the investor.
In fact, it does encourage a lot of discipline, especially when you're investing for your children. So if you're the kind of investor who requires somebody else to enforce discipline, then maybe a long-term insurance policy suits you best. But if you're the self-motivated investor and you can manage it on your own and you're disciplined enough not to touch the money but to regularly invest, then you might be able to look at a mutual fund and stay invested over the long term. You have a question, go ahead.
Given the current scenario, India is fastest growing economy, Sensex is growing crossed 28,000, right? So in terms of safety and return, given for a period of say 10 years, how would you compare investing in mutual funds vis-a-vis gold, vis-a-vis in real estate?
Do you want to take that? Do you have the numbers?
I think it's important to understand the nature of every asset class that we're talking about. Equities by itself in the market, if you're investing and you're looking at a period which is beyond 3, 4 years, 5 years, I think it's a reasonable investment. This is one asset class which definitely helps you beat inflation and makes real returns for you as an investor. If we look at the other asset class, which is real estate and gold, they have their, it's important to have gold in a portfolio because it's considered to be a hedge against inflation. But you should not have too much of gold in your portfolio, because if you look at the historical numbers of gold, they've actually moved in peaks. So there are times of nearly 4, 5 years, 6 years when gold has stayed at a particular value and stayed like that for 4, 5 years, and then suddenly it has moved up in peaks. So on an average for a 10-year, 15-year, maybe you will see it kind of beating inflation a little bit, but otherwise, it's not as non-volatile as we assume gold to be. Okay, so I think from that angle, gold is good to have in the portfolio, but we would not recommend anybody to go beyond 10% of the portfolio allocation in gold. Real estate is something, I think, again, it's very close to most of the Indians and it's real estate. So one has to understand that real estate, is it for consumption or is it for investment? If it's for consumption and we consider it as an investment, I think we kind of end up fooling ourselves, because if I'm staying in a house, you can't liquidate. So it has to be an investment which is outside where I'm not staying. So it's an investment outside. So real estate has been a reasonable investment. Again, it gives you nominal returns on an ongoing basis. If you can rent it out or you can use that real estate for something, it gives you nominal returns. However, liquidation of real estate is not as easy or as simple. So if you're nearing a goal and you have invested real estate to move towards a goal, it's better to start planning liquidation of that asset a few years before you're reaching your goal. So all three asset classes have their own position. I don't say that you should invest only in one of them. In fact, being skewed to any one of them might put you in a wrong end of the cycle, because each of these asset classes have their own cycles. So it's always better to have a balanced portfolio which has, the three components.
All right, you must always, try not to put all of your eggs in one basket and try and spread your risk out over as many asset classes as possible. Quick break. When we come back, we're going to continue talking about picking asset classes and matching it to your goal. That's on the other side. Don't go anywhere.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
हेलो.
लड़की है मामा जी.
क्या? खबर पक्की है?
हाँ जी.
तू क्लिनिक में रुक. समझ गया?
चलो ठीक है.
वो लड़की है जी.
महेश सोच क्या रहा है? बहू को तैयार कर जल्दी.
अरे जल्दी कर. डॉक्टर अपने आनंद मामा जी की पहचान क्या है?
रजनी तैयार हो जाओ, क्लिनिक जाना है.
ऐसी ही सोच से शुरुआत होती है कन्या भ्रूण हत्या की. ये सोच भी हत्या के समान है. अपराधी कड़ी से कड़ी सजा के हकदार हैं.
बेटे की आंख में बेटियों को बलि मत चढ़ाना. औरत की आन बान शान में हमारी बेटियों का भी योगदान है.
BSC, India's most trusted exchange.
Welcome back. You're watching the Swatantra series on ET Now. Thank you so much for staying with us. Our guests are still with us, and so is our audience, and we have a lot of questions to answer today. The young lady at the back, go ahead.
Hi. So considering the current scenario, that is, the new government seems quite positive on infra and real estate, how would you rate investing in real estate or investing in infra debt bonds vis-a-vis investing in mutual funds?
Yeah, two very different things, investing in real estate and investing in infrastructure bonds. Let's take them one at a time. Let's talk about infrastructure bonds first. You want to take?
Infrastructure bonds are by itself a good debt instrument to buy. What it gives you, because it's traded on the secondary market as well, so what it gives you a flexibility to liquidate on the way, even if you don't want to stay till the end of tenure. Now, again, there is a category of tax-free bonds which comes along with the infrastructure bonds. So it has to be important to understand who really benefits more. I mean, if you are in what kind of tax bracket do you actually belong to. So if you look at the rates which are currently available on infrastructure bonds, they're, let's say, around a 7.2 kind of yield is what you might currently be able to pick up these tax-free bonds. So only if you're in a 30% tax bracket would it actually make sense for you to buy an tax-free bond. Otherwise, your other coupon yielding instruments, which is like even bank fixed deposits or some good corporate fixed deposits, they will end up giving you net returns higher than this thing. So I think it's important for you to understand what tax bracket do you belong to, and hence from that angle whether a infrastructure bond is a good investment or not. Again, it's a debt instrument, so whenever you're planning your portfolio, it will go in the portion where you're talking about debt. So it will go and add to that book.
Compare it to a debt mutual fund, because that is another option instead of just taking an infrastructure bond.
Sure. So I was coming to mutual funds now. So your next question was infrastructure bond versus mutual funds. Mutual fund again gives you an option of going across all these segments. So you can invest in debt. You invest in debt, you are actually more diversified than just going and investing into an infrastructure bond. When you're getting a complete hang of debt which is happening. So again, if you have a longer tenure, you can choose a mutual fund which is planning for a longer tenure, which are your dynamic kind of funds which can allocate their assets over a longer period of time. If you're looking at a shorter tenure in debt, purely from a accrual basis as a replacement to FD, either look at an FMP or you can look at short-term debt mutual funds which are available. Equities, obviously, if your goal is again a little long-term, look at equities. If you're looking for a common goal, you need to look at a mix of debt and equity which goes. Real estate, I would say, from an investor, I would always suggest that any investment, because you connected it to saying that current government is focusing on this this thing. From an investor, I would always say making your investments irrespective of trying to time the market, and it has to be with reasonable long-term mindset in place, because if you try to time the market, you never know what's going to happen tomorrow. So if you really think real estate is required in your portfolio, you don't have enough exposure, it's good to go and invest in real estate. Real estate is very specific to locations, kind of property. It's so specific that you will have to do some good research around that. Appreciations happen in pockets. Appreciations do not happen in certain pockets. Certain pockets give you better rent yields.